Good afternoon and welcome to the second quarterly webinar of 2016 in an educational series brought to you by Nasdaq and Brown Flynn. My name is Marissa Bridle, Associate Consultant and Marketing Manager for Brown Flynn, and I'll be going over logistics as well as giving a brief intro to the webinar and our expert panelists. Registrant phone lines are in listen-only mode during the presentation today. We will address questions during our Q&A session at the end. At any time, you can submit questions for the panelists by typing them into the message box that you see on your screen. And if you are experiencing any technical difficulties at any time during the webinar, you are free to call either of the numbers on your screen for technical support. And just as a disclosure, the views and opinions expressed here are those of the authors and do not represent the views of Nasdaq or any of its affiliates and do not constitute financial advice and should not be taken as such. Today's webinar topic is what the Reg SK Concept Paper really means for business. As always, we have Mike Wallace, Managing Director for Brown Flynn, as our moderator, and Evan Harvey, Director of Corporate Responsibility for Nasdaq, providing us context and setting up our expert panelists. We are joined today by special guests Daniel Gelzer from Baker & McKenzie, Adam Kanzer from Domini Social Investments, and Will Martindale from UN PRI. With that, I will turn it over to Mike to give an overview of our webinar series and partnership with Nasdaq. Mike?
Thanks, Marissa, and thanks to all of you for being part of today's webinar. This has been a very successful collaboration with Nasdaq, and Evan Harvey's to be congratulated for helping pull this together as educational programming for primarily focused on Nasdaq issuers. But also Nasdaq's been kind enough to extend this to a wider range of interested stakeholders out there, and over the course of almost 2 years now, we've had a great collection of speakers and presentations from some leading institutions out there that are helping to push this topic of ESG, environmental, social, and governance measurement, management, and reporting. The likes of Microsoft and BlackRock and Bloomberg, some of the ratings or the reporting frameworks that are out there have been part of this, the GRI, IRC, and SASB. We've had discussions about human capital. We've had discussions about sustainable development goals. And then with proxy season, we've recently had a discussion around proxy access with companies like AMD and the U.S. Social Investment Forum. Today we're here with some great experts in the field. We're going to talk about this concept called Reg SK and the public comment period that's going on right now. So Marissa, if you'd move to the next slide, I want to tee up for all of you some of the expertise that we have here with us today. And in light of that, we've got expertise from who consists of former general counsels of the SEC itself. That's Dan Golsler from Baker & McKenzie. We also have Adam Kanzer, who's part of the Investor Advisory Committee for the SEC and part of Domini Social Investment, and Will Martindale from Principles for Responsible Investment. He's going to give us a great perspective on what's going on with the investment community. But for now, I'd like to pass it over to Evan Harvey, Director of Corporate Responsibility with Nasdaq, to take us on a little bit of a tour of what's going on around Reg SK and also to kind of welcome you all to this webinar. Evan, over to you.
Thanks, Mike. It's a pleasure to convene everyone here today for this hour-long webinar on the Reg SK Concept Paper. We were talking a little bit before the call about how much attention and buzz this concept release has generated. So I'm happy that you were able to join and get a little perspective from 3 or 4 different points of view on what's going on here. So we use this webinar series to educate and inform the listed companies in the Nasdaq universe around all kinds of issues related to sustainability, environmental, social, and governance matters. The Regulation SK concept release is certainly in the wheelhouse for that series, and so it's part of our general effort to create and promote ESG awareness among issuers. And I wanted to take a few minutes to just walk through as a background what the Reg SK concept release is, what the timeline is for commentary, what it contains, where does it grow out of, etc. I will caveat my remarks by saying that I am not an attorney, so all of the background nuance and finesse that somebody like Mr. Gelzer might bring to this task would be different than mine. This is meant to be a Cliff's Notes version of what's going on so that you can be quickly up to speed and talk about it capably with your C-suite, your sustainability people, your IR, anybody within the organization. So let's talk about some background on materiality from the SEC in general. As most of you probably know, there is no explicit SEC mandate on corporate disclosure for sustainability issues, climate, carbon, diversity, etc. Somewhat open to debate based on the guidance that they issued in 2010, but most companies seem to take this as gospel. The SEC only broadly requires disclosure of, quote, material information. U.S. companies are largely free to self-determine what that is. And I would suggest that this lack of clarity has created lots of dynamics, including a steady rise in investor activism, contentious and adversarial investor engagement, shareholder resolutions, asymmetrical data, the rise of these third-party frameworks and NGOs. We've got the U.S. Supreme Court definition of materiality from 76 and 2011 that basically put this string of words together that is referenced frequently in our space. A substantial likelihood that the disclosure of the omitted fact would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. So companies have been trying to navigate what that means for them for several years now. Next slide. So the last 5 years prior to 2016, a mixed record. In 2010, the SEC tried to address vagueness in the materiality standard by issuing some interpretive guidance, basically along the lines of what I have here. Climate change may indeed cause risks and opportunities for companies. These issues, when material, must be disclosed in SEC filings. And for a brief period, the SEC stood behind this rule. They issued 49 related company letters and enforcement actions in the first year. But since then, the enforcement and the attention has dropped severely, only 3 in the years since. What's happened away from the SEC? Voluntary disclosure is definitely on the rise. You have 41% of the S&P 500 now including climate and carbon risk in some way in their 10K. 81%, and sometimes that's boilerplate, sometimes that is informative. You have to sort of keep a lot of nuance in mind here. So when I say Cliffs Notes, I really do mean Cliffs Notes. 81% self-report via other means. So that's frameworks, CSR reports, sustainability reports, et cetera. And then you look at the data from the G&A Institute, basically they are reporting that company reporters on ESG has flipped from 20% reporting, 80% non-reporting 5 years ago to 80% reporting, 20% non-reporting now. So the majority is definitely on the side of the reporters. Next. All right, so now we've got this 2-year period where pressure is starting to build. 2015, you've got the institutional investors petitioning the SEC for better climate reporting. You've got this amazing action from New York State and New York City comptrollers. And you've got the members of Congress sending the SEC a letter urging them to take up climate reporting guidance. And then in 2016, we've got the SEC checking in a number of sort of oblique ways. They allowed a stockholder proposal on climate change disclosure and profitability effects to go forward at ExxonMobil. You've got reports back after proxy season of voting percentages on ESG issues reaching all-time highs, not necessarily the threshold to make a difference, but a higher percentage than ever before, 20, 30, 40% in some cases. And then you've got global regulators and exchanges moving forward regardless of what the SEC is doing. You've got the EU reporting directive, which will affect European and American companies. You've got the United Nations Sustainable Stock Exchange Initiative and the WFE Sustainability Working Group, 55 exchanges, 40,000 listed companies around the world working towards a baseline on ESG disclosure. You've got some exchanges like Singapore just announced the other day absolute listing rules related to ESG. Next. All right, so let's get to the heart of the webinar. What is the Reg SK Concept Release? So Reg SK refers to SEC rules that specify disclosure requirements other than financial statements for public company registration, periodic reports, proxy statements, other filings. This comes out of the U.S. Securities and Exchange Acts of 33 and 34. It's basically everything that's non-financial that you have to report. The Commission, if you didn't know this before, occasionally publishes these concept releases, concept papers, to specifically solicit public opinion. And public opinion is retail investor, institutional investor, market participants writ large with regard to potential rulemaking efforts. It does not mean that the Reg SK concept will eventually become a rule in its current form or in some other form, but it is a good indication of what the SEC is looking at as a rule base down the road. The Reg SK release is also part of this ongoing SEC Disclosure Effectiveness Initiative, which was created by the Jobs Act several years ago. And then 3 quick bullet points here, just sort of anecdotal things that might be interesting to you. Public comments are essential to the concept release process. If this generates little comment or no comment or bad comment, it could get swept under the rug. And based on the conversations that this panel has been having, I don't think that's a possibility. You've got dynamics at the SEC. You've got commission turnover, which is fairly likely over the next year. There are 2 vacancies right now. Commissioners are presidential appointees, and we happen to have an election going on this year, and Usually it's a 5-person commission and 3 are chosen from one party and 2 from another. So depending on who wins the election, that could have a significant impact on the SEC's decision to engage on this topic or to disengage on this topic. Next. All right, so the Reg SK concept release is a huge paper, 341 pages, 340 numbered requests for comment. And then Deloitte put out this nice summary shortly after it was published of some of the themes that are in the paper, just to sort of get people used to what we're talking about. And it's all of these and more, talking about everything in corporate reporting: disclosure framework efficacy, data-driven investment and voting, redefining core company info, predicting future performance. How do we put dynamics and metrics around that? Properly accounting for risk management. How do we disclose stock ownership properly? Should the SEC get involved with industry guidelines, sector guidelines, best practices per different types of companies? How do we disclose our public policy engagement? How do we attach filings, exhibits to filings? How do we attach, summary and supporting data to the filings that we send to the SEC? How do we scale requirements? There's even a discussion about the value of quarterly reporting versus semi-annual, so reporting frequency, access and readability, the languages that we use, and the formats that we use to get this information into the regulators' hands are all up for debate in this paper. Next. I want to focus on the specific comment requests that are related to sustainability disclosure, since that is the subject of this webinar series, sustainability in Nasdaq corporates. So there are 8 that the National Law Review, in a really good article a couple weeks ago, pointed out, and I think that these are good to sort of reiterate. If you're trying to get your head around what the potential sustainability impact of this Reg SK concept is for you, consider these comment requests. Think about them in terms of your own company or the stakeholders that you work with, and figure out if this is something that would trigger you to comment yourself. You have a strong opinion about how these things work. You have a story from your past about how it was broken or ineffective, but these are the sort of the key points when it comes to sustainability. So, number 1, adequacy of existing disclosure requirements to basically evaluate material things like climate change risk. 2, sustainability or public policy issues that are important to investors. How does that get into our filings? 3, potential drawbacks to line item sustainability disclosures. Do we want a checkbox format? Do we want a narrative format? Does all this get into the MD&A? Let's just get into some other format that makes more sense. Interaction with sustainability information provided by companies outside of commission filings. So if they're reporting on this, as I said elsewhere, CSR report, a third-party framework, how does that data set inform what the commission is evaluating and what investors have access to? 5, the role of existing or emerging voluntary sustainability reporting frameworks. I would suggest the exchanges are part of this discussion. Consistency of specific sustainability disclosures within the Commission's mandate to protect investors. So, if you believe, as a company, as an investor, as somebody who has a place in the market, as a market participant, that the SEC is required by law to look after the interests of investors, and the interests of investors are not being adequately measured now, and the data that they need to make their investment decisions is not being passed through the conventional filing process. It seems like something that you might want to comment upon. And then 7 and 8, costs and challenges. Basically, what are the resources related to putting another, piece of potential regulatory burden on top of companies? Can we find a way to make a smart mix where we take some other stuff out of the churn and put this in because it seems to be more materially informative? And then how do we scale this for smaller companies and other registrants? How can we make the burden the same on an Intel as opposed to a mom and pop or a bank or something like that in the Midwest? So we'll go on to the next slide. This is how you get to the paper if you haven't been there. Go to the sec.gov site. That little whistle image on the left is the homepage of the U.S. Securities and Exchange Commission website. You can easily find the Reg SK concept release by typing a search. That middle image shows you what the paper looks like. That's the first of, as I said, 300 plus pages. And then the comment apparatus is pretty easy. There's a form that pops up that you can use to submit your comment on behalf of your company. You can also just put something into email and send it to rule-comments@sec.gov. They're pretty lenient about how the commentary gets into the agency. So 3 things that I would like you to take away from this is, take a look at the paper, look at what they're asking for in terms of the comments, and consider what the comment might be from an organization like yours. Next. And I'm just going to conclude with some quotes that I found over the last few weeks that seem kind of interesting, coming from the listed company side, the corporate side, coming from the regulatory side, and coming from the investor side. So basically, we have companies on the left, regulators in the middle, and investors on the right. So we have Andrew Leveris from Dow. Business leaders have to realize that sustainability is not an opt-in, opt-out decision, but part of a long-term value proposition. You've got these two interesting quotes from the SEC, Mary Jo White, in an interview with the Washington Post, saying it's important that investors are getting the right information, accurate information, before they decide to invest. That was specifically related to another regulatory initiative, but I suggest that the Reg SK thing is absolutely part of that mandate. Kara Stein, who's been an advocate, calls this the first step in a dialogue on how to modernize and improve the Commission's disclosure framework, because we're talking about disclosure paradigms and regulatory schemas that have been around for a very long time and may not adequately reflect not only the speed at which data is now being processed and consumed, but also the kinds of data that are being processed and consumed. So, we should never be afraid to look at the ways to improve the efficiency of the reporting process. And I think that at long last, that's what the Reg SK paper is trying to do. Everybody's probably read the Larry Fink BlackRock letter, talking about long-termism and the ESG challenges that companies face. And then my friend Erica Karp, she says this, I've heard her say it a number of times, and I really do believe it. Sustainability in the end is not really about ESG or reporting or another framework. It's really just about corporate excellence, how well you're integrating sophisticated, data-driven, strategic initiatives into your company and planning for the future. I think that's it for me, and we'll get to our other esteemed panelists. Throw it back to Mike.
Thanks, Evan. Thanks for the great overview. I want to ask a couple of questions and remind the audience, we've got quite a few of you on the line in mute mode, but you can write in your questions. We're recording this webinar as we do with all the other previous ones. If you write in your questions, we'll field those along the way. If we don't fit them in, we'll be responding through writing, and we'll get back to you. So please feel free to chime in through the chat function. Evan, from your point of view, we've been doing this webinar series now since the winter of 2014. What are you noticing amongst the Nasdaq issuers? Are you having more productive conversations? Is it kind of going slower than you expected? Are companies getting it when it comes to this type of disclosure?
I think that companies at the top end are totally getting it. Large caps, companies with globally diverse, large supply chains are getting it. I mean, they're getting it in a lot of ways, but they're getting the concept. The conversation is starting from a much more sophisticated and mature place than it was 5 years ago, when we would basically have to go in and educate on what materiality, sustainability, ESG really meant for a number of people in the organization. That's no longer the case. They're totally bought in. They understand the triple bottom line approach. They understand the long-term value creation. They are also, which I think is really interesting, as interested in the long-term value creation piece as the risk aversion piece. So for a long time, this was CYA for a company, basically. Let's get our house in order so that we are not subject to some sort of adverse action that would really be detrimental, but let's look at things that can generate revenue and income for us. So I think that companies are excited to talk about products, services, aspects of their organization and their production that can be made more efficient and made more profitable. That conversation, if I have to pick the slow part, hasn't happened nearly as much or with the same level of sophistication at small and medium enterprises. I know that they're getting caught up in this because they're in the supply chains for larger companies, so they're getting questionnaires just like everybody else. I think there's a presumed resource burden for small and medium enterprises too. But I'm fascinated by the pace of change and uptake on the large end, and a little bit frustrated with the slow uptake on the small and medium side.
It's somewhat understandable given the capacity of some of the larger firms versus the smaller firms. But I think for the audience's purposes too, I want them to realize that you're not just talking about the value of measuring, managing, or reporting these types of things. You do this on behalf of Nasdaq. So can you explain a little bit about how does Nasdaq identify its material topics, and of those topics that are out there in the world when it comes to environmental, social, and governance, are there a few that you feel are definitely material to the majority of companies?
Is there material that cross sector and industry boundaries? Sure. I think there are several issues like that. I mean, climate is the great example. I mean, that is not a issue that is particular to a sneaker manufacturer or a bank or a technology company. That sort of cuts across all of them. I think that gender on the social side is another one that cuts across all of them. Materiality sort of forces you to take a very specific lens and look at what are the factors that are driving performance or inhibiting performance within your organization, the stakeholders that you engage with, and what are they looking for. But I think there are some of those global issues, and I just named a couple of them, that are almost extra industry, extra sector. So, you know, a lot of people on this call will know that we've talked about the frameworks before. We've had a call with SASB and GRI. You know, we have one philosophy that basically says let's pick a couple of very specific reportable metrics within each industry, and that covers everything we need. And then you have another approach that basically says let's have a broad-based sort of comprehensive look at some of these large topics and how companies manage it. I think that both of them are in play. I think that both of them are required in terms of have a great picture of the company. Nasdaq certainly believes in that ourselves. And you know, when you go back to resources and small to medium enterprises, we are a big brand with a fairly healthy revenue stream and a fairly small footprint and a small employee group. So we do everything that we do, try to be an exemplar. We certainly don't overspend on this in any way, and we've managed to get up to a basic level of confidence. And that's the message that I constantly transmit out to the small and medium enterprises, that I know that there's a presumed resource burden, but there are ways to get to basic levels of confidence and engagement on this topic without spending a lot of time or money.
Great, thanks, Evan. We'll come back to you probably with some other questions a little bit later on, but when I move along with the time frame we have over to Dan Gosler from Baker & McKinsey. Dan, if you could unmute your phone, I'd like to bring you on and introduce you, Senior Counsel for Baker & McKinsey, but also formal General Counsel for the Security Exchange Commission. I would love to get some of your history of your work with the SEC, but then also your perspective on Reg SK. Again, for those of you on the webinar, please feel free to write in your questions, and we'll take those during the transitions. Dan, are you there?
Yeah, thanks very much. Yeah, Evan's done a great job of kind of setting the stage here in terms of the concept release. I'd like to say just a little bit more about the context in which these questions are coming up, what the history is of the SEC's consideration of ESG disclosure and kind of the framework in which it views those questions, and then maybe a brief comment about some of the implications for public companies. So to start with the context, I do think it's important for people to keep in mind that this is a broad inquiry about all of the non-financial issues that the SEC requires companies to make disclosure on today. The release isn't specifically focused on ESG disclosure, and again, as I think Evan pointed out, the document is 341 pages long. Sustainability and social responsibility disclosure is 11 pages in the middle of that document. So for reporting public companies, there are many other important issues in this document that you're going to want to take a look at. And by the same token, to the extent that your focus is on sustainability disclosure, this is probably just a small first step in what's likely to be a long and complicated process if the Commission is going to enhance its specific disclosure requirements in this area. It's also maybe good to keep in mind that this disclosure effectiveness initiative that the release is part of comes out of congressional mandates for the Commission to study its disclosure requirements that are aimed somewhat more at simplifying disclosure and reducing the burdens on smaller companies. So those are going to be factors that the Commission will be weighing as it looks at the comments that it gets on this. Evan had a great list from an article in the National Law Journal about the questions that are being asked about ESG disclosure in the release. I would kind of boil those down to three things that you might want to keep in mind as you think about commenting. First, they've asked for feedback about the importance of sustainability and public policy matters to investment and voting decision making. Second, they've asked what specific sustainability, public policy disclosure issues are important in understanding a public company's business and financial condition, and whether there are, or sort of what the considerations are that make that kind of information important to investment and voting decisions. And then third, they've asked what the challenges and costs are. And they do have requirements in their rulemaking to consider costs and burdens, and they have faced some litigation challenging rules where it's been alleged that they haven't properly taken costs and their relationship to benefits into account. So that's something that's very important to them. I think you can kind of trace those questions into the framework that they currently use for ESG disclosure. So let me say a little about that. The basic framework, the rules of the road here, were created from commission decisions that were made in the mid-1970s when they were sued in response to the National Environmental Policy Act, which directed all federal agencies to consider the environmental consequences of things they do. And it was alleged that that required the commission to have a broad disclosure framework for public companies about environmental matters. The commission's conclusions, which were ultimately accepted by the courts, were that it wasn't authorized to consider the promotion of goals and objectives other than those related to what the federal securities laws are trying to accomplish, that is, decision-making about investments and proxy voting. They also concluded that they wouldn't require disclosure on issues that only were important to a very small segment of investors. And they found in the mid-1970s, at least, that socially motivated investment represented about 0.005% of the market. And they concluded, as Evan has emphasized, the touchstone of what should be disclosed in SEC filings was materiality. That is, what would be significant to a reasonable investor in deciding whether to purchase or sell a security or how to vote a proxy. So that's kind of what's guided what they've done in the last 40 years, or the way they've looked at the last 40 years at these kinds of issues. The 2010 SEC climate change release, again, which I think Evan referred to, is a good example of the Commission applying that philosophy to a new and emerging disclosure issue related to what might be called sustainability, or broadly speaking, an environmental issue. And they kind of remind people of the materiality definition and point out that climate change is likely to have material effects on many different registrants. And they say, you should think about it in terms of the required description of the company and its business, which includes a requirement to disclose the material effects that compliance with environmental laws could have on the company's capital expenditures and earnings and competitive position. That's an SK requirement today, which is discussed separately in the release. Climate change could have a material effect on legal proceedings against the company, could have a material effect on the risk factors that the company is required to disclose in its SEC filings, and it could have a material effect on the management discussion and analysis. That is the part, the SK requirement that requires management to kind of give its perspective on its liquidity, capital resources, and results of operations. But there are no specific disclosure requirements about climate change in that release. Companies are just simply guided as to how they should apply the concept of materiality in complying with the existing SK disclosure requirements. Maybe that leads to a short deviation to the Sustainability Accounting Standards Board and its work. The SASB has been working over the last couple of years to develop on an industry-by-industry basis disclosure requirements with respect to sustainability that are consistent with the SEC's materiality definition and the MD&A requirements. The SEC has never formally accepted SASB's work. Compliance with SASB's standards isn't mandatory the way it is with respect to the accounting standards that are set by the Financial Accounting Standards Board, that has at least a similar name, but it's something that companies can look to today on a voluntary basis to get an idea of what may be material in their industry with respect to ESG disclosure. Well, a lot has changed since 1975, and I think that's part of what this release is trying to get at and trying to get information about. And a couple things to bear in mind. And first, Congress has, to some extent, pushed the SEC into requiring disclosures that aren't strictly called for based on the concept of what information a reasonable investor would consider significant in making an investment decision. In Dodd-Frank, there's a requirement that companies make disclosures about conflict minerals used in the production of their products. It's probably well known to many people. There are also disclosure requirements about mine safety, resource extraction payments, and CEO median worker pay ratio, all of which aren't necessarily tied to traditional materiality. Second, and as I think has become clear from things that have already been said on this call, and that I'm sure most of you are very well aware of, the role of sustainability and public policy information in investor decision making has changed substantially since 1975. Whatever the correct percentage was back then, the percentage of investors, particularly institutional investors, that do take sustainability considerations into account in their investment decision making is much higher than the 0.005% cited back in the 70s, and I think there's much more of an appreciation today that consideration of how the company is going to address sustainability issues has a real impact on its economic success and operational effectiveness, and the kinds of things that are traditionally important to investors. Also, of course, voluntary sustainability reporting has mushroomed. Companies obviously feel that there's a reason to make these disclosures, even if they aren't required. Again, I think Evan cited this statistic as well, but something like 81% of the S&P 500 today publishes sustainability report or corporate social responsibility report voluntarily outside the scope of any SEC requirements. So just what does this all mean for the companies that are on the line today and maybe considering commenting? Well, one of the issues that runs through the concept release is to what extent the SEC should rely on principles-based disclosure versus prescriptive disclosure. And I think that's particularly significant in this area. In other words, should the SEC continue to rely on the application of the concept of materiality to the company's specific circumstances and leave it to the company to make judgments about what sustainability information it has to disclose, or should there be specific requirements that all companies have to comply with, like conflict minerals, for example, in particular areas of sustainability? They also raise the question of whether the definition of materiality ought to change. And the Supreme Court has defined materiality as it's used in the securities laws, but the SEC would presumably have the authority to set a lower standard or a different standard with respect to particular topics in its filings. How those questions are answered have a big effect on how public companies make disclosure. I would urge companies to think about how they would come out on those issues, and either through comment letters or through organizations you may participate in, to let the SEC know what your view is. I mean, interestingly, just in talking to clients about this release, I've heard both views on the principles-based versus prescriptive rule debate. I think many companies prefer the principles-based approach because it gives them more latitude to decide what's important in their disclosure. I have had others say they would prefer prescriptive requirements so that there's less argument with stakeholders about what they ought to be disclosing. So I guess I'd just close by saying I think this is sort of a once-in-a-generation opportunity to influence the SEC's thinking on disclosure in a very important area this is very much, I think, the beginning, not the end or even the middle of their consideration of how sustainability disclosure ought to be reflected in SEC filings. But I think it's a real opportunity to influence them.
Thanks, Dan. No, I appreciate the perspective there, and really unique opportunity to have someone like you on the phone today. So we've gotten a lot of questions in. Some are pretty in-depth questions. I think we're going to hold on the questions for now for the sake of time, because I want to also make sure we get Adam and Will in here. So Adam, we're going to transition over to you, if you wouldn't mind popping off of mute and coming online. Adam, I really want your perspective from the asset management, Domini, social investment point of view, but also give us some background on your work over the years with the SEC. You've been at this a long time, so we'd love to hear your very candid comments about what's going on around Reg SK and what companies and investors should be saying. Adam?
Sure. Yeah, thanks a lot, Mike. Good afternoon, everybody. So I suppose since Mike just led off with the SEC piece, I should deliver the standard SEC disclaimer, which is that I don't speak for the Commission and I don't speak for the Investor Advisory Committee. I can only speak for myself. And I should say that is particularly true because as of a couple of weeks ago, my term on the SEC's Investor Advisory Committee came up. So as of now, I'm no longer a member. I hope to be again in the future, but as of now, I'm not. What I'd like to do is talk a little bit about who Domini Social Investments is and our perspective on why we're looking for sustainability information from companies, and in particular mandatory disclosure, and then kind of go through a few of the concepts that I've been wrestling with as I think about putting together our comment letter, and I think I'll touch on some questions on materiality and particularly systemic risk, which is something we haven't really touched on in this call yet. And then I can close by just sort of giving you a sense of the breadth of organizations and comments that I think we can expect to be submitted to the Commission on this. So first off, for those not familiar with us, Domini Social Investments is a mutual fund manager. We're based in New York. We have about $1.6 billion under management for both individual and institutional investors. And we focus exclusively on socially responsible investing. So that means that at the outset, we use social, environmental, and governance factors to select all of our holdings. We're actively managed funds, so we then take that analysis and we work with a sub-manager or with Wellington Management Company to do the financial analysis and put the portfolio together for us. I'm just going to focus on our approach, of course. So we set key performance indicators actually at the sub-industry level. And what we're trying to understand is what are the key sustainability challenges that each company faces within the context of its business model? What is most important for that company? We see this information as indicators of quality management. We think that it helps us to identify better companies, better long-term investments. We also believe that it helps us to manage key societal risks that may, in the long term, also impact returns. It's important to understand that when we set those KPIs, we're looking outward. So we're looking at the company's impact on society and the environment, first and foremost. And I think one way of looking at that is in terms of value creation. If you can't create meaningful, lasting value for society, you'll have challenges creating lasting value for your shareholders. And in terms of risk mitigation, I like to think of it as kind of looking first at where the risk actually begins, which is somewhere out there in the world, pretty far away from stock price. And if we want to reduce that risk, we need to address it where it begins. And so we're actually looking to reduce risk as opposed to price risk, which I think there's a distinction there. And so we use a lot of information to do that. We do look at SEC filings. We look at sustainability reports. We do our own research to find information. We talk to NGOs. We talk to labor unions. We're trying to put together a picture of the company. And there is actually a lot of data out there. There's a lot of information. But it can be hard to get comparable information. It can be hard to get reliable information. We still see situations where industry peers, one company does a fabulous job of disclosure. The other company discloses essentially nothing. And so part of what we do to address that is engage with companies, and that's kind of my role at Domini. And many of the engagements are really focused on improving that company's level of disclosure. And we're hoping that that information that's ultimately produced drives performance within the company, it drives better outcomes on the ground, and hopefully it drives better investment decision-making by investors globally. As part of that, we've been seeking mandatory reporting for many years. So I joined Domini in 1998, and I think one of the first things I did was sign a letter to the SEC saying we should have mandatory sustainability reporting. So we've been working on this in one way or another for quite some time. The idea being that really the SEC should be overseeing this. It's very hard to ensure that you get consistent and accurate information when it's not contained in regulatory filings. There's obviously many, many different ways to go about it, and this concept release really kind of puts everything out there on the table. So it gives us an opportunity to think a little bit creatively, I think. So let me just discuss kind of a few of the limits, I think, that we have to the current model. First off, I think it's important to recognize that we're in a new world since the original kind of disclosure regime was set up. We now have a world of multinational corporations that did not exist in the mid-30s. We have investors that are very broadly diversified and concerned about risks at the portfolio level that did not exist back in the 30s. We have a broad range of systemic risks, including climate change, that did not exist back then. But we still essentially have, it's been modified over time, but we still essentially have the same approach to disclosure. And I think the 2010 climate guidance, which has already been discussed on this call, is really a perfect example of that. It was an opportunity to say, what are the current standards and how do they apply, current standards of materiality, how do they apply to an overarching systemic environmental issue? And it focused exclusively on risk to the company. How does climate change affect the company? Because that is what the MD&A is all about. It hasn't really improved disclosure. And I think that it really points to some of the limits to the MD&A. In our view, management's view of risk is, of course, vitally important, but it is not enough. So I think SASB may be, and could have uniquely positioned to improve the MD&A by providing key indicators for use by management that are tied to the most important sustainability risks per industry. And I also think it's important to think about a third-party standard-setting body as opposed to the SEC trying to figure out all of these issues. And SASB is not the only one that exists out there. But I think that even if we got spectacular disclosure in the MD&A, you'd still see a lot of investors saying that we need more, because we need information to be able to allow us to second-guess management's view of risk. We need, if you look at the MD&A as sort of a 180-degree view of risk, it's risk hitting the company. We need a 360-degree view. We also need to understand how the company affects other companies, how it affects our portfolio, how it affects the economy, how it affects larger systems, including climate systems. So I think investors are going to be asking for more. In my view, line item disclosure is an appropriate way to address that. One, just simply because I don't think you're going to get very useful information if you ask companies, tell us how you're harming the environment. But if we ask them to disclose certain kinds of emissions, that's a neutral data point that they may be quite willing to provide. Take a look at CDP. CDP asks companies to disclose their plans to reduce greenhouse gas emissions over time. Company discusses that in narrative form. And then after that, CDP asks, when you're finished with that, will your overall emissions increase or decrease? And for some companies, the answer is increase, because they have set intensity goals, not absolute reduction goals. For me, and for many investors, that additional question, that increase-decrease question, is material. That's very important for us to know, because that tells us that the company's really working on operational efficiency, but isn't necessarily working on reducing the systemic risk of climate change, which is a much larger risk. I don't think you can get that kind of information if you don't have certain kind of line item disclosures. I'm not really sure how else you can address systemic risk. And if you think about it sort of visually, think of it like a Venn diagram. If you take the entire capital markets, all the companies in the world, and you represent that as a circle, draw a much larger circle around that, and that's climate. And so we're interested in how that large circle affects the small circle, which is currently what the disclosure regime kind of asks companies to disclose. But we're also interested in how the small circle, the capital markets, affect that larger circle, which is climate, which may be, some of what the Financial Stability Board is currently looking at. So, in terms of comment, I think this concept release has generated a lot of interest among the groups that I am aware of that intend to comment. I know ICCR is working on a letter, Ceres, CDP and the Carbon Disclosure Standards Board, I think, just submitted their letter. US SIP is working on a letter. The FACT Coalition, which is a coalition of NGOs working on tax issues, will be submitting a letter. Other NGOs, the UN PRI will be submitting a letter, and I'm sure there are many others. There are other elements also within the concept release that a number of us will be commenting on, including tax disclosures. We don't think we're getting sufficient information to understand the risks of global tax strategies. Share buybacks and sort of broader capital allocation decisions, and subsidiary disclosures, which relate both to tax as well as counterparty risk and other issues. You might want to take a look at the Investor Advisory Committee's letter, which was finalized and submitted a few weeks ago and is posted to the SEC's website. If you look for Spotlight Investor Advisory Committee, you can find the letter there. And that letter, one way to look at that letter is sort of a roadmap of investor concerns throughout the concept release. So it looks at things like, should it be principles-based or rules-based? And we said, well, Reg SK is currently both, and we think that's a good mix. It should be both. It talks about tax, it talks about subsidiary disclosures, it talks about non-GAAP reporting, it talks about sustainability disclosures. So it might be a good roadmap. I just want to close with a quick thought, which is that I would really encourage companies that are doing serious sustainability reporting to comment to the SEC and tell them why you do it and what is the value, what's the value that you seek. Because I know there's a lot of companies that I speak to that say that it really does help them internally to drive operational efficiency, but also to manage risks, better understand their stakeholders, and build long-term value. And I would really love to see companies tell the SEC that this is of great value. The other quick comment I'll make, I had a call with a company recently discussing capital allocation decisions and share buybacks, and I asked, can you tell me about the capital you've allocated to climate adaptation or climate mitigation? And in order to get that answer, I had to go to 3 different reports. I had to look at the 10K, I had to look at the sustainability report, and I had to look at the company's CDP report, which it did post on its website, to its credit. And I asked, well, wouldn't it be better if you took all this information and put it in one place so that we can really get it in context? And the answer was, well, we're going to continue to do this voluntary reporting. We think it's valuable. We think people want it. But we're not going to put it into our SEC filings without guidance from the SEC. So there's a problem there, because there's a lot of material information in those reports. So as a corporation, you might want to think about that as well, and maybe the SEC can help to clarify that. And I will stop there.
Thank you, Adam. And we've got a lot of questions that have come in, particularly aimed at Adam and at Dan at this point, but we want to make sure we use the time wisely. 10 minutes left. We'd left time for the back end for Q&A. Might not get to it. I want to pass it over to Will Martindale, Head of Policy for the Principles for Responsible Investment. And Will's going to give us perspective on a large coalition of investors that are coming together on these issues. And Will, over to you to help bring it home.
Brilliant. Thank you very much, Mike. And it's calling in here from a referendum mania, London, so it's only time perhaps where discussing a 310-page concept release from the SEC is welcome relief. But I wanted to take a few moments just to introduce the PRI, talk about responsible investment more broadly, some of the aspects of the investment chain that we see that are relevant here, and then a few recommendations that the PRI will likely be making to the SEC on this consultation. So just very quickly, PRI Principles for Responsible Investment is an investor-led organization. Investors that sign up commit to 6 principles, one of which is to incorporate environmental, social, and governance issues into their investment decision-making. And principle 3, which is relevant here, is to seek appropriate disclosure on ESG issues by the entities in which those investors invest. The US is our largest signatory base, and the PRI is now, I think it was something like $62 trillion of assets under management. It's half of the institutional investment market, so it's serious assets under management. They've committed to those 6 principles. If we could move forward 2 slides. Thank you. Just wanted to just take a minute just to introduce responsible investment as well, because I'm sure most people on the call are familiar, but there are a few myths here. So responsible investment has nothing to do with philanthropy. It's not about reduced returns. It's not even about limiting the investment universe. It's about mainstream risk opportunity and management. It's about integrating ESG issues as part of the primary analysis of investment decision making, and it's about fulfilling fiduciary duty. In fact, analysis by the PRI conducted with a number of policymakers, investors, and a US law firm concludes that failing to integrate ESG issues is a failure of fiduciary duty, and that's certainly the trajectory that we're seeing. A number of US investors told us that they described that as directionally correct. Relevant to the consultation, if you've read it, there's a section on CSR, and responsible investment and ESG integration is definitely not CSR. CSR often is information unconnected to the core operations of the business, and what we're talking about is the financially material operations of the business. Next slide, please. Just wanted to briefly say that ESG reporting by companies shouldn't be seen in isolation. There is growing demand from beneficiaries. We did some polling last year from a number of different countries of pension fund beneficiaries, and increasing awareness and growing appetite for investors to be considering sustainability issues when they make those investment decisions. There's the Department of Labor's clarification of the ERISA guidelines last year was clear that ESG issues are consistent with fiduciary duty, and there's growing product base from asset managers, stock exchange, indices, and that's feeding right through the investment chain, linking back to companies. So shouldn't therefore be seen in isolation. And on the next slide, briefly want to I'm not going to run through this, and Evan actually mentioned a few of the key policies and regulations from around the rest of the world in his remarks, but to say that the US is very much not in isolation. Indeed, you could be arguing that the SEC is just bringing US securities reporting up to an international standard as part of its consultation. Here there's a non-financial reporting directive which has been passed by the European Union. That the French energy transition law requires mandatory carbon disclosure for both companies and investors. We're seeing a growth of stewardship codes in the Far East. There's a number of consultations going on in Australia, and China is leading a green finance group as part of its presidency of the G20. So it shouldn't be seen in isolation. Next slide, please. I just wanted to briefly touch on the recommendations that the PRI will be making to the SEC on the back of this consultation. I've just summarised it here. The more detailed document is on our website, unpri.org, and we are currently discussing our findings and conclusions with a number of US investors. So they may change slightly, but unlikely to change considerably. So those recommendations are, one, that it's important that ESG factors, and the ESG factors is the language that we use. SASB uses the language material non-financial information, but essentially we're talking about the same thing. So include material ESG factors in the annual report with clear links between those ESG factors and the company's business model, and particularly here looking to remove what others are calling noise. We're not necessarily looking at things that are unconnected with the business model. We're key to the business model. The second is to assure that that data, we recognize that there's not a big market around assurance of ESG factors, so we suggest a phased introduction here. The third thing that we suggest is we need common comparable information. We need to compare that across industry, across portfolio, and importantly across an historical time series. So we're calling for the regulation to clarify that, but then allow enough flexibility such that if there are additional company-specific ESG risks, that companies are able to report on that, and investors are able to use that in their decision making. So I've whipped through that pretty quickly. I'm going to stop there, Mike, in case there's a couple of questions you want to take, but I, of course, would welcome any further questions via email or call afterwards. Thank you.
Yeah, I appreciate that, Will, and appreciate you being on the call from the UK today, and with all that's going on over there with PRI 10-year anniversary, et cetera. So thanks for your perspective on this. We heard a lot of different, a lot of common discussion amongst the group. I guess question to Adam first, and then Dan. Is this truly a step forward, or are we just playing catch up here? We heard some perspective internationally about things that are going on with the stock exchanges, things PRI pointed out about international developments. Is this latest comment period and the discussion about Reg SK a move forward? Adam,
well, it could be. It really depends on how the SEC responds to this. It's quite possible that we won't get anything out of this, but I think it's an important opportunity to try to move forward. I think the United States markets have fallen behind, and it's long overdue, I think, for the SEC to take a hard look at these issues. So it could be an opportunity to catch up, and it could be an opportunity to move beyond where other markets are.
Yeah, and I would just,
what's your perspective?
Yeah, I would just stress again that I think this is a beginning step, because the overall disclosure effectiveness initiative that this is part of is not focused on sustainability. It's kind of a small component of what's going on here. Also, as I think Evan highlighted, the current SEC is not going to be the same SEC as the one that ultimately makes decisions on these issues, because we'll have a new SEC chair next year. We'll have probably 3 new commissioners, including the new chair. So the road is a long one here. Also, I think the SEC is ultimately going to maintain probably a fairly focused approach to investor decision making. They're not going to become the sort of the comprehensive clearinghouse for ESG disclosure.
Thanks for that. And my understanding is that this type of comment period will also be made public, so everyone's going to see who has written their comment in. Is that right, Dan?
Well, maybe that's an important point to stress. Yes, all the comments here are public, so and you'll be able to look at everyone else's comments, and by the same token, anyone that comments should appreciate that their comment will be public.
And on that note, one of the questions that came in is, what are the characteristics of a good comment? What should people be thinking about as they put their information into the system? And how does one get the SEC's attention? Dan, I probably best for you, but Adam, you might have some perspective on that as well.
Well, again, I think someone made this point earlier. I think the more you can put in concrete information coming from your experience as an investor, your experience as a company, something that is fact-based rather than simply opinion, it's going to garner more attention.
Yeah, I would definitely agree with that. I mean, one thing to point out, I've been told by a number of people at the Commission, is that it is 341 pages and there's tons of questions in there, but don't feel obligated to comment on the whole thing. What they're basically saying is, tell us what's important to you. Tell us what you want. And if that means you only have time for a 2-page letter because there's one burning thing that you really want to address, send that letter in. And I think the more you can talk about how you use this information, why it's important to you as an investor, or hopefully as a company as well, that's going to be valuable to the Commission.
Great. Thanks, Adam. And so, just to remind you all, we have recorded this session. Everybody who registered and is listening right now will get a copy of the presentation. We've got a lot of questions that came in. We'll circle back through the panelists and provide any responses that we didn't get to in the way of questions. We're coming on to the end of the hour. This will be posted to all of you, but it'll also go up on our website. Evan, over to you for a final thank you and farewell.
Thanks, Mike. Another good webinar, another sizable chunk of information for companies to digest, but I can't really end on a better note than Adam and Dan just threw out there, which is Nasdaq wants companies to get involved in the discussion. If you are extremely displeased with the Reg SK comment, or if you have an issue with the way the SEC is going about engaging on this issue, pro or con, we would much rather have you part of the discussion than absent on the sidelines or commenting from a part of the spectrum that does not have any impact. Comments will have an impact. More comments will put more light and more heat on this subject. And we are anxious for companies to be proactive in telling the Commission and Nasdaq, the exchange, what is working for them, what's impractical, what's practical, and how they think that we can move forward. So with that, I'll close. We've left the slide up here that shows you where you can find the paper in the comment form. If you have any questions about how to do any of this, feel free to reach out to me. I'm available to you all for any follow-up, and we look forward to having you on another webinar soon, next quarter, in fact. Thank you very much for joining.
Thanks, everyone. Bye-bye.